That means we get to speak to the legendary investor, Mr. Greg Dickerson. How you doing, sir?
Doing great, Michael. How about you?
I'm doing great, man. So one of the things I thought we should do today, I don't know if you've seen it yet, but the stock market's having a little bit of a fuss this morning. Last time I checked, I think it was down 500, which, is a little bit over 1%. But what I thought I would do today, because you and I have seen the stock market have some violent moves during our adulthood. And I thought maybe we should just, we should have some fun and games and say, you know what, let's say the stock market, the Dow, S&P, and NASDAQ were all down 25% in a week. And then we'll play that out. What happens to consumer? What happens to real estate? Because again, depending on how you look at that, it could help real estate or hurt real estate. So again, Greg, what I want to talk about here is, you know what, bingo, bango, the stocks are all down 25%. What do you think kind of happens at the street level, if you will?
Yeah. And we had gotten down about 2% this morning. So it looks like a big move, when you see Dow down 670 points, and, but it was 2%. So 25% is a big number. And I think now we know what we're going to see. The Fed is going to jump in and it's not going to let it get down, but so far, and I can't remember how far they let it go, March of last year before the pandemic. And it really depends on what triggers it. So that's the key.
Okay.
What triggers it is going to depend on the response and how far they let it go. Now, what we saw, I think, in March of 2020 was close to 50%. And it wasn't somewhere around there when the Fed stepped in.
Yeah, certainly high 30s. I don't remember if it ever, I think one of the indexes might have hit 50%. I think the NASDAQ might have, but it was more than 25% for sure. And it was quick.
Yeah, it surprised me because I was waiting for a little bit more downside to jump in, and next thing you know, there they were. So it was fast and it was furious. So Dow peaked at 28,000 on October of 2021. 2020. I'm trying to look at when that was. Okay, what's going on?
Yeah. It's okay. Because when I think about while you look that up, the things that I remember, obviously the .com crash, that was very Silicon Valley based, right? I remember just craziness going on pre-crash. Then, eventually it happened. Then I remember the Great Recession, obviously started in real estate, but really took out a lot of banks and really hurt consumers.
Yeah.
So I think you're right. Okay, there you go.
Yeah, February, March. Okay, so it started in February. It started a little downside action in February, and we were at 29,000 basically, Dow 29, okay. And the bottom wick in March. Let's see, what is this? March 20th was 18,202. So yeah, 12,000. We saw the Dow drop 12,000 points.
Yeah, so about 40%.
40%, and that's when they jumped in. So I think that's their threshold. I think they're not going to let it drop below 50% because that, 30, 40%, 20, 25 in this range of where we are with the Dow and S&P is still correction territory. Now a crash, a bear market is defined by, 20% over, a period of time, but 20, 25% could still be seen as a correction. 40, 50%, you're in crash territory. And then you let it drop below 50% and, you're talking about economic Armageddon.
So let's just play this all out, right? So let's just assume it goes down 25%. So it's at 46,000. So that would mean a 13K fall, I think, 4, 8, 12. Yeah. So 13. So it'd be 33,000. So that would be, that would be uncomfortable. That would be a shock. A lot of people that got in the last year would be hurt. If you're trading on margin, you'd be hurt. You see lots of margin calls. The Fed probably doesn't step in at that point. Cause again, you could get a 20% move just by adjusting the PE, right? There could be like, we're going from a bull market to a bear market and people just adjust their earnings expectations and that'll take the wind out. So, I don't think the Fed, like you said, I don't think the Fed does much at a 20% correction. But yeah, if it jumped to 40%, and certainly if it did it quickly, like that, late February to March drop, they'd be like, oh my God, free fall. We got to do something.
Yeah. And I mean, we're up, so much this year, even a 20, 25% correction, you're still probably up 10, 20%.
Yeah.
If you're going from the year. So it's
year to date.
That's not a big deal. I don't think that's going to be seen as anything huge other than taking profits. If it starts dipping below 25, 30%, that's when you got a problem. And then, you could see the Fed taking action. There'll be some systemic issues with leverage, like you said, in the system, things like that. I mean, that's really the big issue right there. I'm looking at it right now. So basically we're up about 23%. So that would wipe out all the gains for the year. We're up about 23% on the Dow right now. Oh, that's the S&P right now. The Dow is probably about the same from January. Let's take a measure here.
Yeah, I guess the question I have is at what number, and again, it's purely a guess, when do you think it impacts real estate, right? Because a lot of people, at least in the Silicon Valley, a lot of their, let's just be honest, a lot of the down payments in the Silicon Valley are from stocks, right? They're restricted stock grants, RSUs they're called, money that they've set aside. At what point do people go, wow, my 401k is a 201k or whatever you want to joke about? When does it impact real estate? Because it may or may not. I don't know.
It doesn't. So real estate's only impacted by two things: interest rates and liquidity, the availability of financing. That's it. That and that only. Those are the two things that drive real estate. Of course, there's supply and demand. Right now, we still have a housing shortage. So if the housing market is still in the condition it's in right now, and again, when you say real estate, we got to think about what are you talking about. So commercial is very different than residential. But let's just take the housing market, because that's probably the bulk of your viewers
for sure
is housing. So if the housing market remains the same in terms of demand, if interest rates remain as low as they are and you can still borrow money, absolutely zero effect on housing and real estate, none.
Yeah,
and commercial.
I actually think for most of the country, that's absolutely a true statement. I think there are some very bubbly and expensive markets like the Silicon Valley, where I reside and have been for 50 years. I think if specifically, it's not even the Dow, it's the NASDAQ, right? If the NASDAQ got hammered like it did in the .com crash and it went down 50%, you would see less housing transact, because so much of the wealth, so much of the down payment it comes from selling stock. You would definitely see, and I don't think it would be long-term, but I think it would create a pause, right? What I've seen in the Silicon Valley is like when the .com crash comes, it's all horrible. We get like a 6-month window where people are like, oh my God, what's happening? Our stocks going to zero. And then they don't go to zero, obviously. And, it comes back. So I think it creates an air pocket, perhaps in very expensive markets, but I don't think it creates a huge crash. I don't think.
No, it wouldn't create a crash. If anything, it could spur investment, especially in the commercial sector and in REITs and things like that, because there's going to be a rotation. So anytime a market crashes, you have people selling, somebody's buying, so people are taking profits. So that's generally what's creating that situation, is that people are in profit. They're like, let's go ahead and take some profits now. They start selling. That creates a frenzy. So, I mean, if somebody's buying a house or somebody's looking for a house, you and I as real estate investors, the stock market isn't going to affect our decisions.
No, not at all.
Now, we see a lot of people when they're making money in the markets, they'll go and they'll cash out and they'll invest it in real estate. If some people are counting on that to buy a house and their portfolio dips, I've seen people pull back when that happens, and they say, hey, I just took a hit in the market, so I'm going to wait a little bit before I buy because I was going to use that money. So, but that at scale, what's going on right now in the housing market is there's no inventory. Interest rates are record lows. Liquidity is easily available for people that want to borrow. So until that changes, I mean, that's the two fundamental things that drives the real estate: interest rates and, lending, being able to borrow money. Yeah.
One of the side effects, and again, I experienced, and as I've taken time to look back, I think others did as well, right? I was particularly burned by the .com crash and have never really gone back. There were lots of people like me who would play the .com era, thought it was easy, we're day trading. I mean, day trading was a thing. I was in sales and I had employees quit to day trade. I mean, it was a thing. And then the stock market did what the stock market did. And I saw a lot of people take cash out, right? They probably sold near the bottom, but they never went back, or they went back very small, but they took the cash and they became investors in real estate, because now I can see it. I can touch it. I can get cash flow. I can negotiate. It's not this legalized casino run by people in New York. Right. So I did see a lot of that.
That's what I experienced in my market. I was in a resort rental area, short-term vacation rentals, and people were cashing out of their internet stocks and coming down to the beach and buying beach houses.
I remember that, right?
Adding on and renovating their beach houses. And I didn't know anything about what was going on back then in the markets. I didn't really follow them or anything. And, I was asking him about it. I'm like, what in the world? Oh yeah, I made, $1 million over the last year in internet stocks. I was just like, what the heck? I mean,
What is that?
I didn't even have a smartphone at the time. I was still carrying a beeper, and I had cell phones
Yeah,
mounted in the truck,
I
analog cell
remember.
phones.
Yeah.
Yeah. I
Oh,
mean,
that
you're
was so,
talking 1998, 99 time frame, when that
yeah,
was going on,
it was
2000.
crazy. Yeah, I remember. But yeah, that was I I could see the dominoes going that direction. And what I mean by the dominoes is the stock market has its adjustment. September, October have been bad months. October is where the great that I think it was 87, the Black Monday happened, right? So we're kind of staring at some scary months. We have, Congress back in session. We have higher taxes. We have inflation, tapering, lots of stuff going on that could cause a market correction. But
Yeah,
it's,
there could be a market accident. And,
oh, yeah.
for anybody listening, the biggest crashes in the history of the world have been in, September, October timeframe, all of them. If you go
All of them.
back to the Great Panic of, what was it, 1802 or 1902, wherever it was, that was the first one where you had the run on the banks.
Mm-hmm.
That was in the fall. That was September, October. Then you have the, 1929 crash. That was October. The one you just mentioned in the 80s, that was
Yeah.
September, October. And then, of course, the great financial crisis, our last big problem that we had started in September, October, and we reached the bottom by March.
Right.
The following year, which ironically, that's when the pandemic bottom hit.
Yes.
That's when you go back and look at the charts, that started October, November, where the market started rolling over a little bit.
Yeah.
So they were kind of baking a little bit in, and then we had the big accident. So that's where I say real estate, it would all depend on what's triggering it. Okay.
Yeah.
Is it a banking thing, or is it just an asset bubble popping and people are taking profits and then it just, steamrolls from there?
Yeah.
And then what does the Fed do and when? And again, real estate's all about the cash flow. It's all about the financing. Without the financing, there is no deal.
Yep.
So
Agreed.
if you can borrow money and interest rates are low, real estate's going to keep it on. Right now, everybody's conditioned to 3% interest rates. You get close to 4, it's lights out.
Yeah. It's just interesting to kind of relive and again, guess or predict or whatever you want to talk about for the future. I've seen a lot of people get hurt in the stock market and decide, you know what, I'm not going back there. I'm going to be a real estate investor. It just makes sense. It's more tangible. You can calculate cash flow. You can get yield. Why is Wall Street buying single family homes? They're chasing yield. There's just no yield out there. And if the stock market has a hiccup or an air pocket, you could see a lot of people go, whoops, I'm not going back there again. I'm going to buy me some single family or duplexes or quads or whatever it is.
Yeah, it's tricky times. The markets are frothy. Assets are in bubbles everywhere. So this is profit taking season. So you're going to naturally see some corrections because it's time to take profits. And that's what you're seeing. And now we have the China issue. I'm sure we're going to talk about that in another segment. So it's definitely time. If you've got profits on the books, you take some profits or at least return your basis if you don't agree and you think it's going to go to the moon. But the Fed's going to let it drop, but probably not below 50% if we had a huge residual, or some sort of something else that pops up that nobody knows or we can't see going into the rest of this month. And
you mean, Greg, this is not a buy the dip moment?
Buy the dip, you become the dip.
Exactly. Well, Greg,
there's a lot of ways to interpret dip.
Yeah, exactly. Well, this is a lot of fun. I always appreciate these conversations. How can people follow you and be part of your world?
GregDickerson.com. All my info is there. Go check it out.
Thank you, buddy.